But it's good to be back with the trend following traders. And the markets are crazy. The markets are, from my perspective, they're really trending well. My long-term stuff kept me still long all the commodities since late 2020. And the short currency positions came back to life yesterday. I'm not sure why. And my stock index shorts are pretty good too. Some made that change a while back to go long the single stocks and short some indices based on my system, of course. So it was all really good this week. Kind of, I don't know what's going on today, but um, nice trends. We're making good money again, and it's just so. Can you imagine being out there without the diversification and the rules? What do you do in this situation with all the things that are causing these trends, the Ukraine and inflation? It reminds me of other periods where we would invite in brokers who were raising money for our fund or supporting our efforts, and they, during periods when the stock market was really crashing and doing poorly and the world was crazy, they would have no clue. They'd be so totally, what do we do here? And we're like, well, you're at the right place because we can help. We're not always successful, and we're not always putting on the right trades, but we have no problem knowing what we should be doing, and that's a big, huge advantage with systematic trading and trend following. So I'm interested in hear how everyone else is doing, and if you read that article from TransTrend, yeah. And I'll start inviting people up on stage. Let's give everybody a chance to speak and see where we go today.
Hi everyone, very happy as always to be here. Was waiting this for 2 weeks, and I want to say that I'm in a good, I have good performance in commodities. My commodities account collective too, and I have good performance here on oil, and it remind me that, like Mark Jabczynski said, that in every situation that our uniqueness of trend following, really uniqueness, we have unique product, because in every situation when business fails, when stocks fails, trend following have a good performance. So it's one of the latest episodes, maybe in a recent maybe episode with Niels. Mark said this, that in every situation we have profit. We have a profit from trend following trading when all the world is in a not very good situation, and it's uniqueness of the product of trend following strategy.
Hi everyone. Hi Jerry. It's been a very interesting week. Fantastic for trends. Interesting, Jerry. My anything that's denominated with a euro in the currency pair is doing very well with me, short, and I assume that we can directly relate that to the conflict at the moment in Europe. The soybeans are doing fantastically, coffee wonderfully, wheat absolutely nailing it. So I suppose from trend following perspectives, we do revel in this type of uncertain environment. I suppose sort of we can always adopt an ethical position outside of our trading stance, which I tend to do. So there's Richard Brennan, the trader, and there's Richard Brennan, the ethical stance. And I try and sort of avoid the two sort of mixing together. And because trend following, as we know, is agnostic in relation to predictive or causal tendencies, and it's looking at a price following method that is applicable to any liquid market. So if we do adopt an ethical principle to, ESG and all of these different things to restrict our universe, that really compromises our strategy. So I don't do that. But it's been a very interesting week. Look, I did catch up. I had a good read of that TransTrend article. They've obviously done very well and been awarded the Quant Fund Firm of the Year for 2022, I think, or 2021. But I also listened to that podcast you put up on Twitter from John Cruikshank. I think that's his name, from EMC Capital. So that obviously comes from Liz Cheval, who is a turtle trader. Jerry, I'd be very interested to find out from you your thoughts about Liz and how well you knew her, and to get your perspective on things like that. But great to be here.
Hey, hi everyone. These last days have been really rewarding from the trend following perspective, and the moves from the market moves from yesterday makes me wonder the same thing as you just said, Jerry. That how how possibly can anyone face the markets without robust rules and a guide to tell us what should we do in such extreme moments. And just on a side note, I was kicked off my soybeans trade today because of the reversal, and I've been wondering if my trailing stops are being too tight. I feel it has something to do with the extreme high made yesterday, and my trailing stop is based on that. And well, I'm where I am. My trade system is telling me to do something. I'm just following it, not thinking too much about it. I follow the rules, and when I have a clear head, I can spend time thinking about it. And about the article, I have made a couple of notes here I'd like to share with you guys, some of my impressions. And one of the first phrases on the article is, while others in the field have added new elements to their trading programs, such as systematic macro strategies and alternative risk premium models, or launched simpler, cheaper version of their flagship funds, TransTrend has stuck to what it knows. And then I said, okay, good. That's nice. That's classic trend following that they are doing. That's the way to go. But then the phrase ends, though it is seeking to do it differently from other firms and better. And then it got me scratching my head. And well, okay, everybody's trying to do something different and better stuff. Not really sure how much can you improve from classic trend following, but well, fine. And along the article, they try to define something that they call a trend risk, and how they approach it, not by measuring correlations, but through synthetic markets and hybrids. I got the feeling that it sounds like what we were talking couple of sessions ago about those suggestions from Richard that base assets not on the dollar, I mean, not have the dollar as a denominator, but the euro, just like Richard just said, or, well, I don't know, perhaps some other denominator. Why not corn based on soybeans? Well, whatever. And in the article, they suggest that these hybrids are not simply pairs of assets, but perhaps baskets, combinations of more than two. It's not really clear for me if it's just long one asset, short the other, or long two assets and, well, the same signal and not different signals. And along the article, there is some suggestion also that they are trying to capture some macro movement or some fundamental movement through these hybrids. and that's I think it's a big no-no, because, well, we talk all the time that we don't know exactly what are the reasons behind trends. We only know after the fact. And if you're building a synthetic asset that you're trying to capture these fundamental reason ex ante, I'm not sure if it's fine to have this. Um, I would approach this from the top of my head, defining all kinds of combinations, putting all of them in my trend following system, and then the system will pick up and tell me, okay, you have to go long these hybrids and short these hybrids, whatever the reason, and all the combinations are there, not some combinations I cherry picked because I think there is some reason behind this. Oh, there is some reason behind the long short palladium and platinum because the mines of platinum and palladium are the same, and the use for one is for diesel cars and the other is for gasoline cars, and there should be some trend there because the world is moving toward gasoline and out from diesel. Well, whatever, I don't know. My system is telling me to go long or short, and I'll go long or short, whatever the system says. Um, and besides the long short palladium, there's also long short palladium and gold, palladium and silver, palladium and soybeans, whatever. The binding restriction is always capital, but if I'm looking for these hybrids and acid combinations, I would go with all kinds of combinations and not some that I picked as something that makes sense in my head. I don't know. Well, sorry for the rant, but that's what I get from the article.
I had a good read of that article and also their follow-up article on, and the way I see it, that's a very good summary, Bruno. But the way I see it is that they have a very strong position, similar to us, in that they hate the traditional method of using correlations to select assets. So the traditional way of selecting across classic asset classes is a no-no for TransTrend, because they are looking to what they refer to as real factors, and that's to be contrasted with the common terminology you hear about factors such as momentum, volatility, all of those things. So what they're saying is that I think Howard and their firm, they're highly data-driven, highly quantitative research. They are looking for the causal reasons, the real, what they regard as the real causal reasons that drive the trend. And that's where we saw the tweet to Jerry about why does Eugene buy the car? So that they're looking for these real factors and in their analysis, in identifying what they think are the real causal factors, they are therefore developing an asset selection with the use of synthetics and with these things, which is truly uncorrelated, because they're doing effectively what Jerry's doing when Jerry's looking at equity markets and he is deciding which equity market to invest in. The logic he's using is he's looking for a distinct, unique quality of a particular equity asset, and he says, "Oh, that's a good one. I'll do that because that is significantly different to another one, and therefore it's unlikely to be, truly traditionally correlated." And this is what I think Howard's doing, and I think their research team, they've probably been very successful in this, in developing these highly uncorrelated, diversified portfolios. So even though their technique is different to us, because what we do is we say, right, we'll not take any position regarding any particular asset. We'll assume all of them can trend. What Howard's doing is he's saying, right, he's going to force this level of uncorrelated relationship right from the outset in his research. And if he can identify where a trend starts, then this is what I don't agree with. What they do is when they see a trend emerge from a particular asset class that they're following, they'll see how that trend plays out across the universe of markets that they have, and then they'll increase or decrease the level of exposure by virtue of their degree of real factor correlation that exists in those markets. So they are adjusting their portfolio to basically be out of trends when most people are still holding trends. So they're fairly short term, obviously, or medium term in nature, not long term. And when they tend to be out of trends at the time that perhaps the classic trend follower is still remaining in trends, and that's why they proudly say that they don't necessarily get burnt by these short-term, volatile reversals in the market. So it's a different process. There are certain similarities, which I think, even though we use a different process, I think we come to the same result. We come to an uncorrelated, diversified portfolio, but they've got a different process to arrive at that result. But they also definitely do volatility adjust, which we don't like.
But Rich, isn't it? You just said that when they see a trend emerge, they will build their positions based on the number of hybrids that are in which the trend is showing itself.
For example, if we think traditionally where we might have a basket of assets, and they might be fairly highly correlated. When a trend in one of those assets starts up, another trend in another asset starts up because they're fairly highly correlated. So they build this level of risk exposure. In a traditional way, we build this level of risk exposure by virtue of the fact that they're really the same trend. He's saying that there's the same causal source of that trend, even though it's being displayed across these correlated markets. So what they're doing is they're saying, to avoid that, let's look at a research project that truly identifies unique drivers, unique fundamental drivers that identify the reasons for causal variation in trends. And they might say, well, there's a spread arbitrage possibility in this asset class that's going to give this particular nature of trend. They'll assign that as a real causal factor for why a trend will emerge. Then they'll identify another real causal factor. And provided they're happy with the fact that these real causal factors are unrelated in context, then they'll be happy to trade that diversified basket of portfolios. They just won't use traditional correlation measures, which they hate, as we do, and these traditional methods to basically build up their diversified portfolio. But what does change is that as the trend sweeps through, what happens, they like what they call, when a trend emerges in a particular unique asset class, they then want to identify what they call on the fringe. They're referring to this fringe of their universe, the fringes where these uncorrelated trends start to emerge. And they're looking for these unique sources of trend that roll across the market, and therefore they're going into trends of one particular causal factor, moving across to another causal factor, moving across to another causal factor. So they're not trading asset classes, they're trading causal factors, if that makes sense.
But pardon me if I'm too slow on this, but wouldn't we achieve similar results just having different systems looking for a lot of assets, and each system will tell us to take a position, and regardless of the real causal factor?
Yes, I'd say, Bruno, provided we take a very long-term data set, a big sample size, provided we're using sample size as a way to validate the models we use, the assets we use, and provided when we are doing this assessment, we are looking at the impact on the overall portfolio, then the outcome, I believe, will be the same. Because if, for instance, they have found these research-driven causal factors, that will be displayed in the data itself, and we will be picking that up, provided our method is a quantitative approach that uses extensive data sets. So I do believe the outcomes are going to be the same. Where we might differ, though, is in the approach we use to get to that conclusion.
Yeah, I feel that by the way the article is written, is that if in a method such as trends, or I interpret as it is written. And if you can't name the causal factor, if you can't name what's behind the trend, you're not going in. And that's what I think is risky, is dangerous. You may be leaving on the table some juicy profit opportunity. And
Yeah, I agree.
if you simply lecture your validated systems tell you what to do, regardless of the reason, regardless if you can name it or not, you're just doing your trades, and after the fact you discover, oh nice, that was because something happened, some mine exploded, whatever. And it got me wondering if Transtrend is doing one or the other, because I feel that there is a strong commercial reason to name the trends. Oh, this is because a mine was a flood in Chile. Oh, this was because the the rains in Brazil destroyed the harvest. But you just find after the fact. There's nothing to do with your day-to-day decision.
I agree, Bruno. And look, the bottom line comes down to this. When you look at the validated track record of Transtrend, Paul Mulvaney, Chesapeake Capital, some of the other classic trend followers, we're saying Transtrend isn't a classic trend follower in this. For instance, they're not using breakout turtle methodologies. But the validated track record says there isn't a significant material difference between the performance of those funds over the long term. So is all of this effort by Transtrend really worth it? And is it materially different? And what happens if their method, and particularly the volatility adjusting, is a symptom of the last 10 years? You know, what happens in these new environments, which might be much more volatile, much more uncertain? It's not necessarily conclusive that we've got a better approach with Transtrend's approach. It's just a different approach. I do like the fact that they are 100% invested in what they refer to as trend following, even though their interpretation of trend would be different to what we'd say interpretation of trend is. But yeah, it's interesting. Jerry, what are your thoughts?
Yeah, I took away from both of those, well, the article and the EMC podcast, that it's just more of the same. They're selling this product that is sort of trend, but it needs a heavy dose of PhDs and extra rules and research. And of course, they're not hunting outliers, and it's all revolves around the same idea that I would complain that why throw in the need to evaluate trend following with Sharp, but they revel in that. That's what they want to do. This is how they're going to make sales, by continuing to emphasize Sharp and drawdowns from open trade equity, were more the classic. I don't care if people use moving averages or breakouts or what strategies they use to get into trades, but certainly the bottom line has to be hunting the outlier, letting the big profits go, treating profits and losses differently, small losses, large profits. But this is all abandoned by the current group that has the most amount of AUM, because that's what they have embraced. Is we don't we do want to be under the yoke of Sharp and held to that standard. Please don't just evaluate us or anyone by terminal wealth. Oh gosh, that would screw up our whole business model. And but eventually this will fall, because it's not the complete truth, and terminal wealth does matter, and it is okay, if not more right, to take small losses but let profits run in some sort of crazy, uncontrolled, uncapped way. So it's just disappointing. And and the guy from EMC, I tweeted this, said that breakouts no longer work, which he probably didn't really mean it like that. I'm sure he's smarter than that. they certainly don't kind of quote unquote work. Good trend following, regardless if it's breakouts or not, don't work very well from a sharp point of view. So that's I think it just is always going to come back to that. And is your bottom line hunting outliers? And it isn't.
I like the point of Niels and Jerry here that when we are speaking, that when people, not we of course, when people speak, say that trend following doesn't work anymore, what they actually mean that it will be no trends in the world anymore, and so it's nonsense. I'm sure that is so, and we have our strategy based on a structure of the market. And as for me, I understand a lot in trend following that allows me to believe in this system.
In this period, to some degree, reminded me a bit of COVID period because I'm still kind of, I think, in some of the past few weeks, putting on, I'm still putting on some more trades. Like I wasn't fully short ruble, and so there aren't in gold. I was sort of flat gold, so I have to buy gold this week. And so it just brings up this fact that one of the good things about the breakouts is they tend to kind of get you in quickly. And this when the trends are good and the world's crazy, you need to put that trade on now. Put it on now. Like don't delay. I mean, wait for your entry, right? But put it on, and that's the most important thing. Even with a bit of reversing yesterday, you want to get that trade on, and that's the first part. And the most important part of hunting the outlier is: are you in this possible outlier? I mean, it probably won't be an outlier, okay? I mean, but you'll be very sad if you delay and add another filter when the markets get crazy. I think I learned this in 1983, and I'm not 100% consistently doing this, but it just continues to work. And that is the quicker, the more vol in the market, the quicker you do the trade. If it's more like in some of these shorts I've been putting on, they're one ATR past. Now they're two ATR past. Now they're down three ATRs for the day. Quick, don't wait for the bargain. Don't wait for the little rally. Embrace trend following on a daily basis. If the market is really strong and it's really rallying, get in there. The field is going to be messy, but please don't wait for the pullback. That's loser. It's loser mentality. You got to get in there and get it. Take your bad fill, and when you get the fill back, it's already a half an ATR loss. Suck it up. Don't worry about it. You got the trade on. The big money is going to be made in the next 12 to 18 months on that trade, or not. You've got a loss, and it's going to turn into one of your small losses, and it's going to be maybe a bit bigger because of getting in sloppy and getting out sloppy. It's just to have the priorities straight, which is if there's going to be a big one, I want to be on it and don't complain about wanting to get a good fill. But I do that sometimes, and I get paid. I get punished for it. So I keep being reminded that you need to don't worry about getting in a market that's kind of crazy. Yeah, so I think that's the big deal. That's why I'm in favor of emphasizing entry trades. You got to get those things on quickly and then hold on.
I like breakout methods very much because one of the reasons, of course, all the reasons that Jerry said, are very important for me also. But one of the reasons that I like it very much because, and I use only breakout methodology for entering the trades, because it allows us to do. It's very clear. We see that it's certain that it's certain breakout, and we see this. We see our enter, and we can do the same things in the same situation as Jerry teaches us. One enter, one exit, risk management. So it's a key to success in our business to be very consistent. And Jerry said this a lot of times. And breakout methodology helps us to be consistent and to be disciplined in following our rules.
Jerry, I have a quick question. You just said that it is important to take the trade quick and take it especially quicker if the market is too volatile. And I feel that you said that this is true for the entry trades, but do you think that it's equally important for the exit trades? I mean, get out quick if the market's too volatile. If of course, if your system tells you to, or no, for the exit trade is you can take a more relaxed stance.
Well, I think we're just, as humans, we're just prone. We want to talk about. I want to talk about hanging on to the trade and not getting out too quickly, waiting for the exit to get hit. I think it's important to have the long-term exits. Personally, I just can't imagine that. It's been so many years, but I think even as a turtle, I probably did not have an exit that was as short term as yours that got you out of the soybeans. So, um, yeah, so I'm so many. I would give up so much profit on those soybeans, and so I think that I pride myself in having these long term exits and um, focusing on. Um, I mean, when looking at the charts this week, I've just been saying to myself, the gold is in worrying about getting out too quickly. But look how much profit you can give back, and look how much you've already given back, and look how the drawdown you've had in this trade in your portfolio. And so that I think just needs to be fought and say, no, it's the opposite that I'm really concerned about. I don't care so much about my open trade equity and to the stop. That's Niels has that calculation. Um, the distance to the stop in all of his positions. And I think that as that number fluctuates, maybe I don't look at a number like that, but maybe I look at it on a trade by trade basis. But I think the key is to say, no, that's not my issue. My issue is I don't want to get out too quickly. And imagine how far these things can go. And we really just can't imagine in the moment. We can see it in the back test. And so I think that is just so important. But we're so wired to want to get out of the trade and take the profit of the fear of we want to pat ourselves emotionally on the back. And then we have the fear of what are people going to say about me? I'm giving back too much profit. I know that that's incorrect because that's what people in every part of the investment management world is always saying to us. And then they slip in risk adjusted and you're off the hook. I mean, you can do whatever you want to do now. You can get out now, later, small profits, small losses, take profits quickly because it's risk adjusted. It's the magic bullet. Whatever dumbass idea you have, you can justify it now because it's risk adjusted. And so I just think we're so hardwired to get out of these trades in any way we possibly can that we don't really have to worry too much about getting out quicker. We're ready. We got the finger on the button as soon as that exit has been hit. And if need be, we'll go back to the research. I hate that word. Can you imagine any other field? And if you ever read about the big billion-dollar guys who run these hedge funds, these macro funds, never talk about the stuff we talk about, risk adjusted. Can you imagine these guys who make all this money? And recently, their names escape me, but they're in Bloomberg every day of all the billions that they're making. They're not talking about risk adjusted. They're not talking about vol targeting, and they're talking about commodities and currencies and bonds and stocks, the same things that we trade. But they're killing it at making all this money. But the CTAs they can go back to the research and back to the back test if they don't like something and just create another rule. Oh, rule. That's another untouchable. So if you have risk adjusted trading with these rules, well, these rules can be anything. You can have 1,000 of them. Just don't be discretionary. Oh, this is systematic discretion. And then they're so quick in both of those articles and, well, the podcast and the article. The humor there is, how many times do they say robust? So here are people with 1,000 rules and conditions and money management overlay that overrides the systematic rules. They're not even following the rules because money management, once again, is another silver bullet. If you just call something money management with rules to get you the highest risk adjusted return, well, there you go. You can do whatever you want to do. We'll talk bad about discretion, but we're not going to, but we have this systematized discretion. And then they want to call it robust. I don't think they know what the definition of robust is, because one entry, one exit, and a stop loss, which is just something I made up. It can be a bit more than that, of course. The epitome of robustness because it produces such a large sample size.
You got me laughing at the magic bullet of risk adjusted. Really good. Yeah, I must confess, I'm sad. I'm out of my soybeans trade. I feel there's so much more to go, and I am off so early. But that's the system I developed. That's the rules I've found to be that make the most money. What I take from this is I must go back to my to my back test and computer and find better rules. Find rules that tolerate more more givebacks. I don't feel this is right. That's what it is. And fortunately, I'm on the other grains, the other the vegetable oils. They're not off, not yet. Yeah, thanks everyone.
Bruno, I
think
wouldn't worry about that, Bruno, because look, we are all trading models, and a model is our interpretation of how a market behaves. So in our models of trend following, we're looking for this hunting for outliers. Well, the classic trend follower is looking for this hunting for outliers. So their model is configured to address that. Your model is configured to address your hunt for outliers, but it is inevitably driven by your research. So a model is not necessarily a real reflection of what the market does. No one really knows what the market actually does. The market is the market. But we have these models, which is our interpretation of a particular behavior. So if your long-term back tests and your sample size is telling you these rules, that is their rules that are applicable for your model. And Jerry's got different rules for his model, and I've got different rules for my model. But we have a certain alignment in that our underlying philosophy is tending to focus on this hunt for outliers. So, but our models are configured differently. So if you're out of soybeans, well, in accordance with your rules, that's exactly what you've got to do, and you can't be upset with that. And if for instance you decide you want to change your model, you might do some additional research and through a large sample size come up with different rules. But the bottom line is we've got a systematic process. We've got rules which have been generated by a sample size. That is the important prerequisite. Our sort of philosophy or our interpretation, well, that's just how we came to our models. But the real essential sort of glue that holds us together is this systematic application of this rules, which have been generated through this large sample size. So if your system tells you to do what you've got to do, you've got to do it.
That's
I
exactly right. I couldn't agree more. That is perfect. And I just don't think you want to have or it's necessary. And I don't have this view, like I feel like there's more left in soybeans or something. Yeah, I would not encourage that type of thinking. There is nothing left in life except following these rules. And so I have no clue if there's anything left. I don't care if anything is left. I just want to have on the right positions. People ask me, where do you think gold is going? And I'm like, I have no idea where gold is going, but I do know the right position, for me to have in that market, long or short or flat. So I just don't think you want to have that idea. Be very nervous going home at night, not having all the right positions. But I never think about how much is left or regretting something from a fundamental point of view, like the commodity super cycle. I never believed in a commodity super cycle. Why put myself through that? I'll be long. But I do think eventually some of these markets will peter out. We'll get short or flat, corn and beans, one of these days, soon, probably one of these days. And then it could resume. And to outsiders, that would look like a commodity super cycle, and you're supposed to bet on that going up for a long period of time. And we're like, no, we have these systems, and they were long a lot and made a lot of money. And then we actually did get short, took a small loss, and we're back to being long again. This hypothetical possible scenario. But commodity super cycle, defining these things, these big worldwide trends, no, I would not encourage that at all. Just hang in there and follow your system and consistently apply it, like Richard said. It's kind of funny that I had this first client, Richard Dennis, and I had a little bit of money to manage, and I was managing this money, and we were trading so large, we were making 200% a year, and I was making pretty good money. And then when I left there, started Chesapeake, I had this big client, sovereign wealth fund, that I made a ton of money because they were with me for 20 years, and they were my second big, after Richard Dennis, then they became my second biggest positive in my life ever. And now later in life, I've got this second Richard who is encouraging me and helping me see all these insights into what we do. So I'm still looking for that second big
It's
client, though.
called positive feedback, Jerry.
That's right. I'm still looking for that second big client, or the big client that the next big sovereign wealth fund. So I'm on the lookout for that, though.
As I know that I have heard from one businessman that one of the most important principles of success in business, maybe in a lot of areas of life, is to focus on the few, not many. So, in our trend following strategies, we we focus on the few things which are very important. It's exit, enter, risk management. So under all circumstances, and there are a lot of many factors that we can face in our uncertain world, a lot of many. And so here I see applying to these principles, we focus on the main important things on which is market structure is based. So we have enter rules, exit rules, and stop loss, like Jerry teaches, and so. And we must be always in a long-term perspective. We must be always be successful doing this, and I'm absolutely sure that it is so.
That's exactly right, Oleg. Look, there is such simplicity in what we do, because what we're saying to ourselves is, let's only concern ourselves with those monumental trade events that lead to these spectacular profits that we can never estimate or gauge their magnitude. So we recognize that the most successful traders in the world owe their success to maybe only, a handful of trades over their trading career that lead to this phenomenal success. Now, they would never have achieved that degree of phenomenal success if they had volatility targeted those positions, or if they had taken, adopted a profit target which was based on their thought processes. So what we're saying is our model is so simple. We've got one entry, one stop, one exit, which is asymmetrically orientated for those magnificent moves that we can never anticipate. We are going to sacrifice all of the small alpha that we're not concerned with, like the individual characteristics of a market, or the precise details of the oscillations that occur in a market, or how it oscillates around an equilibrium. We don't care about that small change. We're after these monumental moves, and we need a process that therefore allows us to increase the frequency of those monumental moves under a portfolio. So we diversify incredibly widely. We have medium to long-term lookbacks to remove a lot of the noise, such as mean reversion and noise that occurs in the more sort of intraday territory, short-term territory. We're only looking for these spectacular monumental moves. We've got a position, a model that is open-ended in profit extent with a trailing stop or an exit that can get us out. Yes, we will never get the full profit, but we'll get a large proportion of it. And that's as simple as our model is. And we can demonstrate using incredible sample size that across a vast array of different market regimes, because we're not concerned with the regimes, the change that occurs in a particular regime. We just know that these monumental profits exist, and our process allows us to hunt for them. It's as simple as that.
Let me just rephrase one thing. I just said that I had the feel that there was more to go on the soybean trade, and that was my my reptile brain saying anything. Jerry, thanks for the punch in the gut. I'm terribly wrong saying something like that. There's nothing we can tell about the developing markets. We all know about the past. Let me rephrase that. What I meant is the market is so volatile that any past volatility measure now is outdated, and I feel now I can use that that verb. I feel that my system is too trigger happy in observing such a small move based on today's volatility and deciding to exit. I feel that there is something fundamentally wrong with the rules I found that prompt me to go back to the research table and see if it's being more tolerant of volatility wouldn't be better in the whole back test. That's what I meant.
That might be right, Bruno. Like, you might be overfit. You might find that your models, if you have intensively developed those models using historical data, you might find that they're overfit. So in our world of hunting for outliers, we've got two components to fitness. We are underfit in relation to our profit potential. In other words, we pay no heed to what the market has delivered in the past in relation to profits. Because we are totally sort of agnostic about the ability of a market to generate future profits. We've got no idea, we've got no level of expectation about future profits. We're just after these outliers. So we've got an open-ended profit condition. In other words, we let profits run until their expiry, and that expiry is determined by the market. And so this open-ended profit of our systems is unconstrained. And because it's unconstrained, it's therefore underfit. However, what we do need to constrain is our risk. We've got to this notion of cutting losses short. Well, how short? The problem you face with soybeans might be that you have overfit your risk constraints for, not a big enough sample of data across a broad array of different markets. So ideally, to increase your sample size, you don't just want to test your models on a single market with 30 years history. You want to test that risk control across all of those markets in your portfolio, because you are applying the same principle or the same model to all markets. Therefore, you are upping your sample size by however many markets in your portfolio. So there's 100 markets in your portfolio, 100 by 30 years. That therefore gives you a much better or much more robust risk management level to set your stops and trailing stops at, because we are using an ATR-based normalization method that ensures that each market is treated the same way. Therefore, we are simply being presented with 100 different alternative possible histories to test our risk mitigation methods in our systems across. So you want to not be overfit for a single market with your risk mitigation, like soybeans. You want that model to therefore be fit to your entire portfolio. Does that make sense?
I like
Yeah,
this very
yeah.
much. Yes, also, I want to say that. I like this very much because we apply universal principles and to all the markets, and it's a very, very good idea to test, to have back test in different markets. For example, we have 10 years or 20 years back test on Japanese yen, and we have 10 years or 20 years back test on soybeans. And the principles are the same, and I have understood this maybe 7 or 8 years ago. That, and it's our sample size. It's been much more sample size. It's a good sample size. And so, of course, maybe there are some individual characteristics of the markets, maybe, but we, what we do is, as I say this, I always say this, that what we do is based on a market structure, based on universal principles, and we backtest these principles, how they work in our systems. And so it's a very good idea to backtest in different markets.
Yeah, I totally agree, Rich and Oleg. The and rest assured, my sample is indeed it does consider all these markets. What I feel the problem I'm facing, I think, is with a tolerance for the give back. I feel that I have found some rules that don't give back too much, and the constraint is not necessarily built in the system. Is it's more of the researcher talking here, you know.
Is that not give too much back? Is that what's nailed you out of soybeans? In other words,
Yeah, exactly. Yeah. Um,
so
a couple of sessions
or
ago.
isn't that suggesting overfit?
Yeah, yeah, it does suggest. What I'm saying is that it's the problem is not the number of markets I'm taking into consideration in the back test, but the the assumption or the realization that I do have to give back more if I want to make more money. Simple as that.
Exactly, exactly. And you know, Jerry's talked about it. We've talked about it. We hate the give back, but it is so essential that we have the give back to allow our principle of cutting losses short, letting profits run to play through, because we can never anticipate how far these out. You know, we are all predictive players in this market, no matter how, you know, we've got a predictive brain. We always think that something has gone too high, yet the market always demonstrates that we're always wrong in that assumption, and it can go far, far higher. And that's how an outlier forms. It's always defeating what a predictive mind is trying to measure. It's saying the market. It's that statement that it's that liquidity statement. The market can stay solvent far more than I can't remember who said that, but anyway, it's that sort of
It's the
statement.
other way around, Richard.
Yeah, the other way around. But you know, it's exactly that.
And I want to say that um, I learned first to handle the drawdown, and I learned it many years ago to handle this drawdown, and it wasn't easy. Also, it wasn't easy to learn to handle the drawdown, to be systematic, to be disciplined. But to handle the trend is, for me personally, it was more difficult for me, and because of Jerry, because of Niels, because of Moritz, I understood that they have much more experience, much more sample size, and they know much more than me about this. And I felt this, I must handle this, and now I learned to do, and I can do this. And so, and I think that if a person works on a construction building, of course it's okay to have maybe everyday salary. Okay, it's okay because it's such a specific of this work. But the specific of a hunter of an for outliers, here is maybe laws of nature and laws of big money, big business. So here it's we must to learn this. For me personally, it's one of the most important things for me to learn how to handle this pressure. And my recipes, as I said before and said today, is to be focused only on the rules, only on the trend, not only on not all on the fundamental factors, not on the opinion of investors. One one exit, one enter, stop loss. Okay, focus on this only, and the best recipe.
Also, Bruno, just quickly, make sure your models are only looking at your realized balance, not looking at your equity. So when we talk about giving profit back off the table, if you're looking at equity, it's an incredibly hard road to take because we do give back a lot. But when you're looking at realized balance, because our whole principle is preservation of capital, we're allowing our profits to run. So we must accept there's going to be significant volatility in those profits. And it's best not to look. But provided our models have been tested using realized balance as opposed to equity, they should naturally fall on a solution that, yeah, it does give a lot of give back in the profit, but they're very, once again, the word robust.
This is amazing stuff, and I'll probably, in all fairness, replay this recording a few times because I had a severe moment of weakness yesterday when after many losses, waking up to all my positions, blasting off in my favor. And I've kind of extended my exits a little bit, just, lifestyle considerations and some of the back testing that I've done. But the first thing I did was to fire up, different platforms and try to do some quote unquote research to see what is the tightest stop that I could have or exit that I could have to maintain some of those profits. And it wasn't a good 40 minutes into it that I caught myself and realized what a fragile human I was for even thinking such a thing, and then had to close my platform. So it's interesting that we're having this conversation and much needed.
Yeah, I mean, once again, I would just say that if someone was to look at my systems, they would just say, "Wow, you're going to give back a lot of profit," and I would I would want them. I would say that that's good. Yeah, I want you to say that. I mean, I want you to say that because you're going to make more money, and you're not going to increase your real risk by defaulting more towards. I'm more fearful of not maximizing the profit on each one of these trades and getting out too quickly. And so, how do you make these choices? Simply by the back test. The back test will reward you for having longer term systems. It'll say to you, and so you can talk to yourself during the day and say, Jerry, calm it down, embrace this. You're getting your ass kicked, but over a long period of time, you're going to make more money. I brought this idea up yesterday in Derek's Clubhouse. I don't know if it's completely correct, but they were talking about technical analysis versus trend or systems, and then quants came in, And then I was thinking, well, I think, maybe quants and technical analysis people, and the majority of humans, they're really concerned about this trade, this week, this month. What are we going to do now? What's the right thing to do today? Where the classic systematic trend follower, they're like, yeah, I mean, it's not going to work out for me this week, this year, this day, whatever, probably, because I don't really look at things like that. It's the long term. I'm going to handle this trade today in this market the same way that I'm going to handle it for the rest of my life. I'm going to wait for this exit, and it's a long term exit. And so I'm not even concerned about um, maximizing this particular trade with signals and indicators. Indicating what? No, there's no such thing as an indicator in these markets. So what I am interested in, though, is maximizing my wealth over all of these trades. But clients care about these trades. They care desperately about your performance, and so do you. So do I. I mean, I don't like to have a bad performance. I don't even like having a bad relative performance. I mean, my ego kicks in. Um, but when the turtles, came out and were taught and then went off and started their own companies, we all left there. And when we were there, we just were taught, that clients are a problem, your ego is a problem, your humanity is a problem. There was no talk about starting these big companies, having lots of assets under management. It was great, to trade your own money, to trade a few friends' money, have this independence, not have to listen to other people judge you, unqualified people judging you. They have no clue what the right thing to do is. They couldn't trade. I mean, we meet so many people over the years who were giving me the business over my performance, or critiquing me of my past performance and saying they weren't not going to invest in my fund. I was making 2 and 20, and they were doing everything in their power to get to my side of the table. They didn't know a damn thing about trading, and they were judging me. And so, can you imagine if they were right? Can you imagine if you really did need these PhDs, if you really did need something other than the classical trend following, if risk adjusted rate of returns was relevant? I just decided to embrace my good fortune and embrace the idea that I could be independent with this approach and not need other people. And yeah, so I think I just wanted to say that count your blessings if you don't work for a big company and you're struggling to get a bit of AUM so you can trade your own money and maybe a few friends, because that's exactly where you want to be in the long run. And this is exactly what these systems will give you in this type of trading: maximum safety and uncapped upside. It's not going to be any better anywhere else than with any other strategy.
And I think in almost all areas of life and a lot of areas of life, if we can minimize our ego and minimize this judgment, how we think about the judgment of us, of the people. And it depends what we think about this, not what they think. And it gives a lot of power to the person, a lot of ability to grow if you don't care much what most of your clients, most of the people think about you, and follow the rules, be disciplined, and I'm sure it's right way here. And people's memory is short maybe here, because when they see your success, they are talking about your success. When they see that you're in a drawdown, they think it's a failure. They're talking about the failure. But in fact, they will forget this. In fact, they're thinking about their money, about their problems, most of them. And when they will see in a long time horizon, they will see that you are in profit. You have 10 years, 15 years, 20 years, good track record. You are successful for them. And so I don't think, and as I said before today, that um, first of all, focusing on our rules, it's focusing on it, but not on the opinion of. We can focus on opinion of best experts in the field, We must think about this, backtest their ideas. Maybe it's very good to learn from the best, but not from the people who don't know how to do what you're doing well.
Yeah, I understand where you're coming from, but from my experience at least, I think finance is a little bit different. Whereas you have to care if you want to raise the AUM, right? If you're trading your own money, like Jerry mentioned, or if you're trading the money of, a couple of friends, even then you have to care. But the matter of fact is that in finance, it is about the image. It is about the fancy system. It is about the PhDs, rather unfortunately at this point, right? It is about who has that marketing strategy. How many ways can we redefine trend following or, macro strategies to make it sound complex, to make it sound better, to make it sound, trendier, or whatever the case may be. That will get you the money. Um, Unfortunately, it's not just enough to rely on a system or to rely on, whatever the case, or experts, whatever the case, however you want to dub it, when you're trying to raise other people's money. I mean, this is why the hedge fund industry is so successful. And to a vast degree, the majority of them are not even profitable, but their marketing machines are great. And that's unfortunately one of those things in finance that I found through experience to be true.
And I think that if you do the right thing, do the hard thing, like Jerry said, you will be successful. Because, for example, if you have 5 years track record, and your competitors have only good narratives, I don't think that it's very they are better in marketing terms because you have you must educate them, of course. And my here is my good 5 years track record, for example, and I will tell you how I did this. Yes, there is a price for that. It's a drawdown, and so on and so forth. And I think that you will find the clients that will pay you for this system, that will be your clients, your investors, and you will find them. And you will produce a good result for them in the long term. And other people, a lot of other funds will not. And here is my point, and maybe I'm wrong in something. I don't know exactly, but I have this point.
Yeah, I think you'd have a hard time convincing institutions, state pensions of that strategy, right? Especially over 20, 30 years, and we're talking about, billions of dollars or millions of dollars. You'd have a hard time because what good is very relative, and unfortunately, a lot of people have very short-term thinking because they have, for whatever reason, right? So we're not just talking about the individual investor, Bob across the street who you can sit over a beer and convince to him, listen, like this is what it is. We're also talking about the heavyweights, the big guys who can really really substantially add to your AUM. I mean, I could be wrong on this, but just from my experience, I mean, I've never ran a fund, but a little bit of experience on the outskirts in terms of the marketing strategies and so forth. So maybe Jerry could come in with this, but I just have a hard time believing that you could go to you know the state pensions or whatever and try to convince them that they're going to have to sit through 30 to potentially 40% drawdowns over 20, 30 years to come out, and trying to convince them that this is a good system, because they also have people that they're accountable for. They're going to be asking them questions of, hey, why am I down so much? And the conversation of, well, this is just part of the system, is a difficult one at that institutional level.
I think in order to convince people, you have to step in their world. And I do agree with Boris in that sense that obviously these are there are factors that are being looked at often in the finance world. So in that case, they will have a hard time understanding or believe in being convinced if you're not talking the same lingo that they've been speaking to 10 other parties to. So it's almost the case of either you step in their world or you stay in your world, and um, people might step in or not step in, but it's hard to convince someone without stepping in their way of thinking.
I agree with all of that. Uh, when I was listening to the Derek's Clubhouse yesterday, I was in the car with my wife, and she was listening as well. And so someone said something like that. You have to have a good story and a narrative more than in maybe de-emphasize the trend following. And she was like, "Well, that's correct." I'm like, "Oh yeah, I know that's correct." So, and I think, and I had an interaction with Harold on LinkedIn, and I think I have a hard time understanding what he's saying a lot of times, but I think he was he obviously doesn't agree with my strategy, and nor do I agree with his. I like him a lot though, and he's smart, and I like their performance. But I think he was kind of criticizing my attitude, as best I could tell, in that it's a detriment to CTAs or the industry, or for him or whatever, for people like me to not kind of more toe the line on what clients want to hear, which I think he's probably correct. Um, and if I was 25 years old, like was at one point starting out, I might be a little bit less crabby about it all. But I do think that you do want to maximize your AUM. It's probably somewhat of a different strategy than maximizing your terminal wealth. But I will still contend, as I have before, that the vast majority of these people who run these larger firms and really do talk about risk-adjusted returns and Sharpe, they honestly believe it. And they're not just pulling the wool over clients. They love it. They embrace it in the same way we embrace our stuff. It's just that they're raising a lot more money. And if you go down that route, that is the route to go. But if you can't, then it's you still have a superior trading strategy. That was kind of a joke. I mean, jokey. I'm being kind of jokey, right? But anyways, Bruno, you've been quiet for the whole clubhouse. The other Bruno, what do you think about all this talking?
I was actually listening because I didn't get a chance to read the trans trend. And listening to Richard, it really spurred my curiosity to go and have a read, because it seems to me like trans trends are, of course, not taking the correlation matrix at face value. So, running it as people normally do, but they are looking at factors, different things. So, there might be something very, very interesting to draw inspiration from. And so I kept it quiet because it's one of the rare occasions where believe it or not, I feel like I have nothing to say, and just a lot to learn from you guys. And so, but it's all good for me. It's all quite interesting.
I think you'll like it, Bruno, because in the Trans Trend article, it might not be the one where it was talking about Harold winning the prize. It was the one that Harold linked Jerry to in relation to what they call real causal factors. They've definitely got this opinion that the traditional way of assigning factors is inappropriate, and there is another way to identify real causal drivers, which their R&D team is focused on. But what they're specifically looking at, they're obviously excelling or particularly focused on this correlation problem. They don't like the linear correlation solution, and they're particularly focused on nonlinear correlations in relation to their real factors. So what that means is that once they've assigned, or once they've identified what they regard as these real causal drivers, which they obviously do through their R&D, they then measure the strength of the correlations that exist in their portfolio based on the whether different assets in their portfolio start demonstrating the same correlation relationship to other assets. And then what they'll do is they'll adjust their risk accordingly. So they're continuously reweighting their portfolios in relation to how they're worried about the nonlinear correlation. So if they start finding that these correlations change and they can be associated with one factor as opposed to many factors, they'll be out of that like a lightning. They're looking at uncorrelated relationships persist. So it's very interesting. It's a different way of looking at the problem, but it's certainly not something that our philosophy looks at.
Yeah, sounds like they have a very graph theory approach to measuring correlation. So, they go one or many steps beyond hierarchical risk parity, and they sort of factor that correlation matrix in a way that, looks at how many different edges point in at each of the individual nodes, which they call them, factors. And then if there are one too many nodes or they don't like it, as you said, they're just going to call it, too risky a position and just cut it off. So it seems very interesting, at least, from a research standpoint. Of course, they made it work, but like many things in life, one thing is reading the paper, quite another is making it happen.
Yeah, so it effectively it isolates them as a unique trend follower. Their methodology is fairly unique amongst other trend followers, and there's the classic trend followers, which we are, and then there are these trend followers that start blending some of these macro strategies into their portfolios. Now, Trend hate that, and I give them a huge tick for hating that, because I think, Jerry, all of us, we hate that. That's their method of smoothing portfolios. But then Trend say that they can smooth their portfolios and particularly focus on the short to medium term trend by this process, which uniquely positions them. So it's definitely worth getting your head around if you can understand it. And tell me, Jerry, Liz Cheval, tell us about her. And do you remember her well?
I do. She was wonderful and very smart, and from Chicago. And so the only woman hired as a turtle. And I've told this story before, that, and she and I sat next to each other for a couple of years. The office was a row of 12, a 12 rows of two desks next to each other. And she and I sat next to each other and laughed it up and, ate Snickers bars and stuff and enjoyed, you know, um, trading together. And, but so when we went for the interview in the fall of '83, I think they had 1,000 resumes, and then they had 40 interviews, I think. And I think Rich asked everybody in the interview, how much do you already know about trading? How much do you already know? As a percentage of knowing it all, 100%, what percentage do you know? And then Curtis was 17, and he ended up being the big hero in the beginning. He made a lot of money and was the best at following the rules. And he said probably close to 100%. And I think I said like 90%. And Liz said close to zero. So there you have it. She was obviously correct. And that was her attitude and mentality. And she was good from the very beginning. She had an experience in the pits, I believe, working as a runner or some such thing in Chicago. But I think she had a math degree as well. And so she was just absolutely a wonderful person. And I think she threw my wife's first baby shower for our first child in 1985. So she was just great. And Brian Proctor works for EMC. The current guy who runs it, John, he is not a turtle, but I think they're trying to carry on Liz's legacy. And I do think that part of her legacy is emphasis on research and evolving. And the firm probably looks very similar now to what it would be if she was still running it. So I'm kind of the outlier, no pun intended, to be perfectly happy to just continue to believe all the stuff that was hammered into my head and expand it in a way that doesn't run afoul of classic trend following. But I don't think that anybody, none of the other alumni mentors,
Sorry, Jerry, your line is breaking up.
they were not necessarily trend as much as they were systematic. And a lot of people have often said have made disparaging marks to breakouts. So I'm kind of on my own as carrying the trend following banner from the turtle years.
That's how I understand it. I had a look at EMC Capital and that video, and it's clear that I think their models, their classic model is 50% trend, 50% momentum. I think they're dabbling more with sort of blending macro strategies into their portfolio, but particularly also one of the things that concerned me was when John Cruikshank mentioned how they use a utility function. This is effectively a way to appease investors in attracting this AUM. But so they use this utility function. What is the desired return you want for a particular year? And the investors come back with a particular level. And so when they achieve that target for the year, that's it. They basically drop their models and wait for the next year to arrive, which, you know, that is so different to our philosophy. And when he started saying that, I thought, oh, gee, they are very different to what we propose.
Yeah, I do. In listening to that, he used some terms that I have not heard in 20 or 30 years, but I do remember them from my time in Chicago. And one of them was this utility function. You know, I remember hearing this from some of my mentors, and they never explained it to us as a group. But this idea of utility, it reminded me a bit of ergodicity, which I've had that explained to me recently many times, and I still don't understand that. And I think even Rob mentioned that he didn't understand it. So I felt a little bit better because, you know, he's really a smart guy. And then this idea of super value, I couldn't, I guess I'll have to go back and try to listen more carefully, but I didn't understand super value either. But I do remember those terms being thrown around when I was in Chicago in the 80s, and they still survive. And so there is that, I don't know, if I wanted to be critical, I would say uh, people who want to sound like Bill, they throw these terms around, but I don't really understand them. And I don't know if you picked up on super value or if you could explain
Yeah,
utility.
no, I did pick up that super value, and I think they're using that as like a global variable, which ensures that all of their signals are aligned. Their short term, medium term, long term. Once that super value's hit, that confirms their signal or something like that. I'd need to go back to it, Jerry.
Oh, I think I can help with the utility. It comes from the microeconomics class. And the utility is a way to measure an individual welfare. And it's a mathematical construct. It's as if you can aggregate all of the things that make you feel well and turn it into a single number. Mathematically, it's as simple as a function. And for a concrete example, in Markowitz, the the utility form he uses is such that an investor gains utility when he sees average return going up, and he loses utility when he sees volatility going up. So he postulates a mathematical form for this utility function and solves for the utility to find what's the best combination of average return and volatility that maximizes utility. In a way, in a word, is welfare.
I do think there's this idea that enough is enough. If you have this big trend, and this is the dilemma I've talked about, you know, we have these big dilemmas like this when we're making lots of money. I mean, it's kind of a joke, right? When do you get your most stressed? I have on all these open positions that are making tons and tons of money. That's not so bad, is it? Because a lot of people, they have the opposite situation. I'm down 50%. I'm losing tons. Now what should I do? Um, but I do think that at some point in time, you you've made so much money in the soybean trade, and you say to yourself, I mean, I'm up 100% for the year, or I've made so much money in these markets, and the market is crazy. Then I've often said it's not going to hurt to take a bit off, because losing some of that back is kind of more important than making a bit more, And so I'm just saying, it's call it discretion, because that's what it is. Don't kid yourself that you've done this back test and you've analyzed these trends and these outliers, which defies sort of a back test. And now I can know what to do right now. No, you can't. Just get out of some so you can sleep at night. You've made a lot. Congratulate yourself. You've made 500 in Tesla, 500 ATRs in Tesla. Then that's okay. Take some off. I think that's fine. I think at some point it's okay to say to yourself, if I lose 20% or 30% from here, that's worth more to me than if I make another 20 or 30%. Um, yeah, I think if that's utility, I'm all for it. It's just a discretionary move. And then I don't think in the long run you'll make more money doing it. Um, you'll make more money probably just following the system.
Jerry, what you just described is called logarithmic utility, because if you plot it, at the beginning, you really care about gains towards the end of your utility function. You don't care about the incremental gains like a pizza. When you have the first couple of slices, you're really enjoying it, and then by the end of it, you're sort of struggling to finish it. You're enjoying it a lot less. So yeah, that's basically a brilliant application of utility theory. Utility theory is used a lot in conjunction, as Bruno said, in conjunction with portfolio management, because the utility function is the objective function that you feed to the optimizer. And it all sounds very, I know, it all sounds very, it's, almost like blasphemy to you guys, but it's the way that, we parameterize things in abstract terms. So then, we look for the search space and we sort of rank opportunities based on a certain set of prior assumptions. So that's why it's important. But just to give the opposite side of the argument, the reason why utility theory is so rubbish is because this is a concept developed in the 60s when mathematical and simulation tools were completely different from now. So we need to do a better job in order to apply them and achieve a credible set of results and be able to tell a credible story to investors, because some of the points that you guys make, your simplicity, your intellectual rigor of looking for an outlier, and all these wonderful vocabulary and vernacular that Richard developed, it's really strong. And I agree with all of the things you guys are saying, against volatility targeting and utility management and all of that, because the tools we use are so poor, and we need to do a much better job if we want to be credible at spinning our side of the story. I do think, however, that utility theory is a, a way to describe what investors should care about, and you can change your utility based on your wealth, your age, and stuff like that. So it's not just one size fits all, but there are many different flavors of it.
Oh no, Bruno, if I'm not mistaken, utility comes from the 19th century. It's really old, and in the 60s it got all this mathematical overlay, and things got worse from there. But the theory is it's much more of a philosophical thing than mathematics. And just to make the bridge, Jerry, you just talked about ergodicity. All the critique from all Peters and the guys from uh, ergodic economics is that when you bring uncertainty and risk to the table, utility theory as it is postulated, it makes little sense, because there are adverse events that would push your utility down to zero in a blink of an eye. And if you simply calculate average utility just using probabilities, you will get the average, the expected utility, uh, not not as bad as it really is. Think about it. If you catch a plane and it has a and in the end you will I don't know, in the end of the trip you will make $100, and if you don't make the trip you will make $0. But if your plane fall down, you lose all your money, and let's suppose all you care about is money, and all your money is, I don't know, $10,000. So when you calculate, and that plane has a negligible probability of falling, it's, I don't know, 0.1%. So if I'm making the calculations right, you have 0.1% of chance of falling times minus 10,000, that gets you minus 100%. And if you do make the trip, it's $100 you're going to make, and it's well, approximately $100 up when you multiply by the probability of the plane not falling. And not going to the trip is simply zero money in the end, because you won't make anything. And if you bring utility theory to this trade-off to decide if you're going to take the trip or not, you'll say, well, it's there is a fair chance of the plane falling down, but when I calculate the odds, it makes sense to catch the plane. But when you go back to the real world, it makes no sense at all. 0.1% of chance of this plane falling is a lot. You're going to lose everything. You're going to lose it all, and that's where ergodicity bites. There are some extreme events. Then when you simply multiply by the probability of happening, it would make sense from an average perspective to take the risk, but it absolutely does not.
That's very good. And it does remind me of how we were taught to that very subject, and so at the same time you want to have these simple few rules that do not pay any attention to those concerns. We're just going to do these trades, one entry, one exit, a stop loss, head down for the rest of our life, fixed portfolio, using capital, closed equity, closed capital as our trade level, without any regard to what they called at the time risk of ruin. Then how is this possible? Well, because we had one more rule, and especially trading the leverage we traded, and 20 markets, 20 some markets, and 200% returns. I lost 50% in one day once. What was this rule? Well, the rule is cut back your trading size and your positions when you start having these drawdowns, and you cut back twice as fast as the drawdown. If you're down 10%, trade 20% smaller. If you're down 20%, trade 40% smaller. So this was this rapid fire way of reducing risk. So you you can almost start to eliminate the chance of risk of ruin. And of course, it makes it difficult to come out of that hole because you've done that. But they definitely did not ignore that subject.
I was just going to compliment that risk of ruin is something that classic economic theory does not take into consideration, and that's where Paul Peters comes for a great contribution.
Totally agree. Jerry, on Curtis Faith, I believe he was responsible for developing that software trading blocks. Is that right?
I think you're right. I think he had some contribution to that. Coming out of the the training course, everyone professed and promised to follow the rules, but boy, he was the best. He just had no fear. 17-year-old kid, and Rich loved this kid. I mean, he thought he was so good and funny. And during the trading course, we'd be taught all of these conservative ideas like trade small. You're as bad as you're going to be. I remember getting a question. We'd pose these questions and say to us, "Okay, here's the question. Write one sentence and send it over to us." And so, I know once I didn't understand the question, but choice A was preserve capital, and choice B was something else. And so everyone knew the answer was A, which was preserve capital, because this was this big emphasis in the classroom and rhetorically on trading small and being fearful that you were going to have uh, lose too much money and get kicked out of the game. But in reality, people who ignored all of that were really rewarded. And Curtis was trading so large. And I remember one time we had this sheet, and it was the ATR, it was the market, and it would be the ATR, and then it would be the quantity. And he looked at the quantity incorrectly because he bought the number of contracts based upon the value of the ATR. So the ATR was 50, and the max contracts was 10, and he bought 50. And Rich just thought that was so funny. And so Curtis
Funny.
was Curtis was so good out of the box and holding on to trends and taking all of the trades. But he's kind of flamed out, I guess, and didn't have a long-term view or love, for trading, like someone like me. And but that first famous trade for the Turtles was Feb heating oil of 1984. And if you go back and look at the chart, crude kind of sat there. Jan heating oil was no good. March heating oil was no good. It was Feb heating oil. So we've often talked in these conversations the importance of trading correlated markets. And I mentioned a few weeks ago Richard's podcast with Niels, where he talks about people who use correlation as a risk to reduce risk, whereas trend followers have the luxury of not having to do that. Go back and listen to that, and I tweeted it as well. And so we've talked about this correlation and how we will trade crude and heating oil and unleaded and even Brent, let's say, because something can happen within these markets. You can get an outlier in a group of markets that are highly correlated. They become uncorrelated, and then they go back to being correlated. So this is exactly what happened. But this happened within a month. Jan heating oil didn't go anywhere. March didn't go anywhere. It was only Feb. It's within months now, not even within a market. It's within a month, and it was because it was a freeze in the New York harbor, and they couldn't get the Feb heating oil in there. And he nailed that trade, while the rest of us were like dumbfounded. We had the rules, and we knew exactly what to do. We didn't pick the phone up. I don't know why. Why didn't I pick the phone up? How did I blow the Feb heating oil 1984 trade? And then, of course, we didn't have technology. We had computers, but the quote machine didn't have a fancy chart on it. We had a chart book. We had to fill in these books each week. We get a new book on Monday, and we would write, fill in the open, high, low, close for all the markets throughout the week. And the chart book company, one day they got rid of Feb heating oil because they just rolled it to March. But we were still long Feb heating oil, or Curtis was. And so he had to create his own graph paper and tape it to the very top because the prices were exceeding, the previous week's maximum price on the chart. And so he was carrying around this homemade chart book, showing this outlier trade that he had to sort of create out of his own graph paper. So I don't know if you followed that, but it was just really hilarious. And I remember one of the guys that followed the turtles was one of Rich's friends, let's say, and he was in the turtle class, but he was not a turtle. He was just uh, participating in the class. He heard that there was this young kid upstairs who was long Feb heating oil making all this money. And he said something like, I opened up my chart book and Feb heating oil wasn't even in there. I just thought that was pretty funny. So, you know, it's just the thrill of, I mean, I think hitting singles in baseball, that can be fun as well. But hitting these tremendous home runs and standing up on that podium, having hit these big home runs, the thrill of these outliers and being there and participating in them, and it affects your life. You know, you look back in your history and you talk about your children and your marriage, and then that heating oil trade. You know, that's where you want to be. Nailing these outliers is so much fun, and people will be jealous.
By the way, I love this story about heating oil.
What's going on, Brian?
I bet you Brian's gardening.
No, I'm here. Sorry, I was off app. Um, things are good, and I think we've been validated with the latest price movements, and it just goes to show that when all hell's breaking loose, keep it simple and follow price. And it reaffirmed our positions that were already pre-existing because the macros lined up accordingly for price to move. And I'm not saying macro trading, I'm saying just the you know the environment itself was already aligned that allowed for our winners to become those extreme outliers. So I think that again it validates the simplicity of our approach.
There is a level of guilt with it, though, because as you're making a windfall, the rest of the world is turning into chaos. That's one of the things I find it hard to come to grips with.
Oh, I don't. I think from a philosophical standpoint, though, you just don't gloat, and everything will work out in the end. Because as was mentioned earlier, they kind of kick the crap out of us anyway. The rest of the time, so um, I hope our folks, our friends here that run funds or are trying to build funds can use this segment uh, to to validate their approaches and ultimately gain significant assets under management.
One other thing worth mentioning that I got an email from the broker Darvinex. Hope I'm pronouncing that right. They're based out of the UK, but they've always had the ability for you to have managed accounts and then you know take fees and stuff through what they call Darwin's. But if people are not familiar with it, they did release a program, I think this week or last week, kind of managing your own funds and running funds, and they kind of do a lot of the back end stuff. There's obviously a fee, which I don't think is too bad, but for the administrative legal costs. But if anybody's interested, might be worth checking out the broker.
Jeff, how are things today?
It's going all right. Um, just watching the news, just being interested. There's so many things happening, so it's kind of interesting to see things happening, unfolding, and then trying to see what's happening in the price. So I'm just laying back and trying to soak all up.
Oleg, is this something you can discuss, or you might not want to discuss it at all? But how are you feeling being over in Russia with what's happening, the events at the moment?
Um, I don't know even want to say. I want to don't think much about this, but I don't think that people of Russia are glad. I don't know. I don't know. I don't think that people of Russia are glad with this situation. And as for me, I'm not glad. I think war is evil. Every war is evil, maybe almost every war. And I'm against this. So here's my point. It's I don't know in details. I did not speak much with someone, but there is not much. I think people who really like it. Maybe I'm wrong, but I think that it's evil and all what I want to say here.
Thanks, Oleg. You're up in St. Petersburg, aren't you?
Now I'm not in St. Petersburg. Now I'm in Anapa. It's in the south of Russia. Yes, I was in St. Petersburg for nearly 5-6 months, and now for a few months I decided to go to South Russia on the Black Sea coast. It's I'm originally from that places, and now just now I'm in Black Sea coast, South Russia.
Stay
Hey,
safe.
Oleg. Yeah, I was going to say be safe, bud. And I'll say I had my 8 semesters of Russian 30 years ago, so I'll just say, Gli Vojna. And I say that as a veteran, so I appreciate your position. And I thought about you immediately when I had heard that they had kind of shut down trading on the Moscow exchange and had prevented short selling. So I hope whatever's going on there, doesn't impact you adversely. So I've been thinking about you.
Thank you very much, Brian, for this. And I think that I don't trade on Moscow Exchange. I trade on Collective 2 and on one London-based firm, prop trading. And so I don't trade. It's my position not to trade in Russian banks because it's very high cost there, and I don't trust Russian financial system. So I think that it must not be impacted on me, and I want it not be impacted on the other people of Russia, because there are a lot of good, kind people in Russia who don't want war, who don't want it, don't want. They want like United States people, like people all the world, civilized world. People want to be happy, live with their families, and live happy lives, but not this.
Yeah,
Yeah,
glad
I
to hear
think
you're
we can
okay,
all
Oleg.
agree that. I was just
Oh,
going to
sorry,
say,
go
I
ahead.
think we can
Go
all
ahead.
agree that people are beautiful and countries, all countries suck at the end of the day.
I'll just say maybe you meant governments, but
Yeah, that's exactly what I meant.
yeah. But
Thank you for the clarification.
yeah. I thought about you too, Oleg, and we love you. And we love Russian people. I've been to Russia. I have Russian friends and Ukrainian friends, and so I appreciate you and appreciate your support. And um, we just wish you the best and the best for everybody over there. And anyways, I think that's a good way to end, and a good sobering thing to remind us how much fun trading is, but it's not the most important thing in life, not even close. So, anyways, at that, I'll say sign off, goodbye, and I will definitely be back next Friday, same time. Hopefully, we don't have any of these hiccups with meetings. I pride myself. We had a long, uninterrupted streak there of meetings, and but it's good to take off. One of the turtle rules was you could just imagine, you go to this job. It's the greatest job in the world. You're learning from the smartest people on the planet and something you're passionate about. The day ends at 2:10. Crude closes at 2:10. I would walk home and just get a call from the S&P close when I got home at 3:15. But one of the rules was you must take a vacation for a week every, couple of months. You're just like, this is not going to get any better, right? And so I think it's good to take a vacation and let your mind rest. So maybe we'll have another forced cancellation of our weekly meeting one of these days, but I won't look forward to it. But there could be some benefit to it. So, anyways, good luck to everybody. Happy trading, and have a good weekend, everybody. Thank you so much. Until next week. Goodbye.
Thank you so much. Thank you so much for kind words. Thank you. I appreciated it very much.
Thanks,
Yep.
guys.
Thanks, everyone.
Bye.
Bye.
Be well.